Hello, and welcome to this video on issues with accounting quality. Our goal is to learn how to value a company through financial statement analysis. However, to conduct financial statement analysis, we need to think about whether we can actually trust the information in the financial statements. Is it accurate? Is it telling a true story? Or is it perhaps biased and misleading in the information that it presents? There's lots of TV shows and movies about problems with accounting. Here are a couple of ones I suggest you check out. Dirty Money is on Netflix and it has a fantastic episode on the pharmaceutical industry, in particular a company called Valiant Pharmaceuticals, and all the mischief they got up to with their accounting and how they were completely misrepresenting the value of their business through their accounting choices. The Wizard of Lies is about Bernie Madoff, who ran the world's largest ever Ponzi scheme. And Enron, the smartest guys in the room, is a documentary looking at the failure of Enron. And it mentions all the different accounting problems that Enron had and how some analysts found out about them. And the research that went into finding all these accounting problems was immense. And in this lecture, we're going to talk about some of the ways we can look for problems with firms' accounting so that we don't run into one of these potential fraudulent companies. So to create financial statements, there's a whole range of different factors that all feed into their creation. So down here in this figure, we've got financial statements. And financial statements are created based on a firm's accounting system. And the firm's accounting system is influenced by the accounting strategy the managers choose, which is influenced by the firm's business strategy. The firm's business operations, business environment, and accounting environment all feed into the accounting system as well. So there are all these various different factors that influence what accounting statements actually look like. We can just change any one of these particular variables and our financial statements will be different. So if we change the capital market structure or the accounting regulations, or if we change our business strategy or our managers make different accounting choices, any of these changes will lead to our financial statements. So financial statements can be very subjective. We see the numbers listed in them. Our assets are $1 million. But that asset of $1 million may actually require a lot of subjectivity in getting to that $1 million value, or whether even the asset is an asset or an expense. So in this video, we're going to discuss different reasons for accounting distortions and why sometimes accounting quality can be poor. So we've got 3 reasons we're going to go through. The first one is when GAAP is not equal to economic reality. GAAP stands for Generally Accepted Accounting Principles. We can have forecast errors, and we can also have managerial manipulation. So let's look at each of these 3 categories. The first category that may lead to accounting distortions is when our generally accepted accounting principles do not equal economic reality. And within our accounting rules, there are all sorts of situations in which this can occur. So let's have a look at an example with some assets and liabilities. So if I go and buy goods for $50 that I eventually hope to sell to customers, the accounting rules say that I can record that as an asset called inventory, and I'm going to have an asset on my balance sheet worth $50. However, if I go and spend $300 in research and development to develop a new drug, and the drug seems to be working well in trials, but has not yet been approved for sale, I can't call that an asset. The accounting rules say that has to be an expense. So in both cases, I go and spend money on something that I think will have a future benefit to my business, that I hope to be able to sell. But in one situation, I can call it an asset. In the other situation, I can't call it an asset, and it's going to lead to an expense reducing my profit. So the accounting regulations may distort reality. On the liability side of the balance sheet, our accounting regulation may again distort reality. So if I go and buy goods from a supplier for $50, but I don't have to pay until next year, my liability, called accounts payable, is going to be $50. However, if another company is suing me for breach of contract, and I'm defending myself, but it's possible I could lose the case and still be forced to pay a really large amount of money to them, I don't actually have to record a liability in this case, so my liability is 0. In both situations, we may be required to pay money in the future, so we may owe someone some money, that is, we've got a liability, but in this case it's certain and we have to record it, whereas in this case with the court case, it's so uncertain we don't actually have to record the liability straight up. There are other issues that always pop up with accounting. Some big ones are brand values are not recognized as assets. So when you look at companies like Coca-Cola or McDonald's that have these ubiquitous brands that everyone's heard about, well, they can't actually put the full value of their brand on their balance sheet. So every time Coca-Cola and McDonald's put an ad on television and it's improving their brand value, they actually have to record that as an expense. Companies that have been around for a long time may have purchased land a long time ago, and that land would have been much, much cheaper than it is today in cities like Sydney, which have experienced a lot of appreciation of land values. So land prices in the balance sheet might reflect an old purchase price. It's reliable, it's historic cost, but it may no longer be relevant. It might be completely out of date information. So if we're following historic cost, our information will be reliable, but it may lose relevance as time goes on. For inventory, it's measured at the lower of cost or net realizable value, and it cannot reflect increased value until it's sold. So you might have inventory that is really popular and is going up in value, but you have to wait until you sell it before you can actually record that gain in value as a revenue. Whereas for other assets, you may be able to revalue them up as the value changes. So all these situations represent cases where what's actually going on in the business may not be reflected perfectly in the financial statements. Another case of accounting quality potentially being misleading is when forecast errors occur. Accrual accounting requires us to forecast all sorts of future outcomes. Some of the ones you will remember from your introductory accounting subjects would be things like depreciation. To record depreciation, you need to estimate what's going to happen in the future. You need to be able to predict the useful life of an asset, and you need to be able to predict the residual value of that asset as well. So these are forecasts of future value for the asset, and you're going to make mistakes with these. So whenever you make mistakes with these forecasts of future use of assets, it's going to lead to misstatements in your financial statements. Now, if our forecasts are just a little bit off and they're randomly distributed with the errors because we're trying our best, over time that will sort of balance out. However, if we're deliberately misleading and deliberately making overly optimistic forecast assumptions, that could lead to biased accounting information. For an account like accounts receivable, you need to record an allowance for bad debt and record your bad debt expense in the income statement. Again, if you're trying your best with your estimations and you're making some innocent forecasting errors, over time that should balance out. But if you're deliberately overstating the credit quality of your customers and you're deliberately understating your bad debt expense, that will lead to higher reported profits and higher accounts receivable due to a lower allowance for bad debt. So that would lead to biased financial statements. For your inventory, we need to make sure we're able to sell it at the price we think we can sell it for. If it's out of date, if it's old stock, we might need to have an inventory impairment and lower the values down. And similar story for our property, plant and equipment. We need to make sure that its value in use is recorded correctly. We need to make sure that it doesn't need to be impaired and that we're depreciating it correctly. And this all requires forecasting of future performance. So if our forecasts are accurate, our financial statements will be accurate. If our forecasts are pretty good and we're making some innocent errors that are sort of randomly distributed, our accounting quality should be okay. But if our forecasts are deliberately misleading, our accounting might become very biased. This slide here lists for a range of different industries some of the accounts which may potentially be biased or misleading or easy to make errors in. For example, for a pharmaceutical company or a drug company, their research and development is a huge driver of value. So the quality of their research and development expenditure is a huge driver of the firm's value. What they can then capitalize onto the balance sheet and how they're spending that money is a really important thing to get right for their accounting. For manufacturing companies, their warranties and their warranty provisions will be an important thing. If they're improving their quality of manufacturing, their warranty expense and warranty provisions will decrease over time. However, if they're cutting costs and trying to make things quicker and faster at a lower price, then maybe we'll see warranty expense and warranty provisions have to increase over time. So for different industries, they each have different potential flashpoints and accounting issues that you need to be aware of and try and think about analyzing. Our third category of accounting issues that pop up is due to managerial manipulation. So management is responsible for creating the financial statements. The CEO, the Chief Executive Officer, and the CFO, the Chief Financial Officer, they're going to be in charge of the accounting choices that a company makes. They get to apply the accounting standards as they see fit for their company. So that means managers have discretion over the choice of accounting policies used and the estimates made in their financial statements. Of course, they have to follow the accounting regulations, but the accounting regulations allow for choice. Management should use this discretion to signal private information and make the highest quality accounting statements they possibly can. However, managers sometimes have incentives to bias their accounting information, and they may use their choice and their discretion to deliberately bias the information. So let's look at situations in which managers may have these incentives. The following factors have all been shown in empirical research to provide incentives for managers to perhaps bias their financial statements and their financial information. So let's have a look at some of these categories and how it may lead to managers changing their accounting policies. In a research article by Graham Harvey and Raj Kapol in 2005, they surveyed managers about their approach to accounting statements and if they're likely to bias the accounting information or engage in earnings management. So they were asking why managers would actually engage in earnings management, and the number one reason is to build credibility with capital markets, maintain or increase stock prices, make sure they maintain their reputation. So managers admit that they have pressure to engage in earnings management, and they have really strong pressure and solid reasons for doing so. In this slide, it asks, how would you actually go about improving your earnings if it looks like your company may come in below your desired earnings target? And the ones that are highlighted yellow, the issues which are actually potentially accounting manipulation issues. So managers have said about 40% of managers admitted that they might book revenues now rather than next quarter if justified in either quarter. They might postpone taking an accounting charge, and they might alter accounting assumptions, e.g. allowances and pensions, at only about 5%. So these are managers saying, if we're going to be short on our earnings targets, we've got all these different ways we could achieve that. Some of them will be actually changing our business behavior, such as reducing spending, whereas these ones in yellow might actually be making accounting choices that could get us to reach our targets. This figure here is from a paper by Bergstaller and Dechev, and what they were looking at is this line here is what analysts expect a company's earnings to be. So that is kind of, we predict that next year Qantas is going to make a $1 billion profit. And then we look at if Qantas earned more than that $1 billion profit or less than that $1 billion profit. And they've got a distribution of all the different firms, so a histogram of the firm's earnings surprise. And they notice at this line, there's an indent to the left that's a bit low. So there's less firms recording just missing their targets, but a lot more firms than would be expected recording that they're just meeting their benchmarks. So they call this benchmark beating. And these kind of patterns show up no matter how we're measuring our firm performance, whether it's analyst earnings or improving your earnings from the prior year or just earning above zero profit. What it's trying to show is that managers are likely to use some sort of accounting choices to make sure their earnings are just above the benchmark they have set. Okay? And it seems to be a little bit of a quirk in the statistical distribution that not many people are just missing, but a lot of firms are just beating their targets. Again, this is evidence that managers face pressure to beat benchmarks, and they may use accounting choices to bias their earnings to reach those targets. In this paper by one of UTS's professors, Professor Peter Wells, who you may have seen in other subjects, especially teaching standards, he looked at when CEOs change. When a company has a change in CEO, he finds that earnings management is present. When a new CEO comes in, they are very likely to engage in what's called big bath accounting. And what they'll try and do is they'll try and bring any expenses forward. So they might impair certain assets. They may increase depreciation. They may try and bring forward R&D expenditures and maintenance expenditures, all these potential costs of the business, both the real costs and via accounting changes. And they'll bring that into their first year of performance. Then they'll report a lower than expected profit in their first year as CEO, and they might blame that on the prior CEO. And they'll say, this year I took over and, it was a tough year to take over because we had all these expenses that were left over from the prior CEO. But next year, that's when you'll actually see how good of a CEO I am. Because they've brought all their expenses forward this year, they report a much reduced profit. Next year, they've got less expenses and they can report a higher than expected profit and show off how much of a good CEO they are. So when CEOs change, there's a strong incentive for the new CEO in their first year to engage in big bath accounting, which means they'll bring forward a lot of their expenses, report a lower than expected profit in their first year, leading hopefully, due to accrual accounting, a higher than expected profit in their second year, where they can say that's all because of how good of a CEO they are. Some CEOs and companies really favor having smooth earnings. GE, General Electric, is one of the largest companies in the world, they were one of the largest companies in the world, and their CEO, Jack Welch, was a very famous CEO, and he was always receiving a lot of credit for being such a fantastic leader of the business. And if we look at their earnings per share growth each year, it's incredibly smooth. Then when a new CEO came in, their earnings per share growth became incredibly volatile. It appears as though the prior CEO had a preference for very smooth earnings. He never wanted to surprise anyone. He wanted every year the earnings to go up by about 15%, and they would use accounting choices to make that happen. Whereas the new CEO obviously didn't have that same preference and was perhaps reporting maybe in a more accurate way, or just had a difference in accounting strategy. Following on from that, a lot of newspaper articles and analysts have figured out that GE were engaging in all sorts of potentially poor accounting methodologies. So accounting tricks catch up with GE. GE shares fall as the SEC, which is the Securities and Exchange Commission, and the Department of Justice expand investigations of accounting practices. So they're actually getting investigated for potentially confusing or maybe illegal accounting behavior. We know people are motivated by money. Managers are definitely motivated by money. In this paper, it looks at managers' bonuses, and it finds that managers are likely to manipulate their earnings to maximize the value of their bonuses. And in prior papers, they've shown that if a manager is reaching the maximum of their bonus in a certain year, once they reach that maximum bonus level, there's not really much incentive to improve performance beyond that. So you might save up some of your firm's performance for next year to make it easier to earn your bonus next year. So we need to look at the manager's bonus and incentives for reaching certain profit targets and see how that might influence the accounting as well. When managers are going through the IPO process, which is an initial public offering, it's when a private company is selling shares to the public. It is going public. So when you're a manager of a company that's going public, you're trying to raise capital. You're trying to get money from shareholders in the public. So you want your company to look as good as possible so you can sell your company for the highest possible price to the public. So this study here from Teo, Wong and Rao looked at accounting in IPO companies, so initial public offering companies. And in the year of an IPO, they looked at some ratios such as the net income over sales, that is your profit margin. And in the year of the IPO companies had an average profit margin of 4.6%. Then in the couple of years after, we see the profit margins rapidly decline. Now that could be due to competition, or it could be because in the year of the IPO, they were trying to maximize their profit margins to look good for the sale. Similarly, abnormal accruals over book value, they use this measure of the difference between cash flows and your income statement to see how much accrual accounting you're using. It's very high in the year of the IPO, and then it reverses in future years. So this again could be evidence of earnings management. And finally, looking at a specific account, your allowance for uncollectibles over your gross accounts receivable. In the year of the IPO, it was 2.9%. You expected 2.9% of your customers not to pay you back. But then suddenly, after you're a public company, the percentage of customers you think will not pay you back is increasing each year. So this is all evidence that when companies are going public, managers may have incentives to make the company look more profitable, and they might use accounting tricks such as using more accruals and being very optimistic with some of their account estimations to make that company look better, and slowly that will unwind in the following years. So in conclusion, accounting is designed to provide information about companies, and we're going to use that information to try and value the company. However, we need to be aware that there are certain areas which might lead to accounting information being misleading or biased. And those areas we looked at are when the accounting regulations do not equal economic reality, when companies have forecast errors, and when managers have incentives to deliberately bias the accounting information that they release. So we need to be able to investigate a company's accounting before we know if we can trust it.